Okay, so today I want to do something a little bit different. It was, I guess I got the idea from my father-in-law, Andy, as we were driving up to Harvest, which is a golf course in Kelowna. And it was kind of funny because the two of us had never really talked about my podcast, even though I mentioned him as kind of my mentor. And so when he found out what I was doing, he was quite interested, number one. And then he actually started to give me some suggestions. And one of the suggestions was first, he wanted to find out kind of what the format of the podcast was. And I said, right now, it's predominantly just one person, me, and giving kind of advice and ideas on how I think about investing in commercial real estate, lessons I've learned, and I've kind of got a framework that I take people through. And he said, okay. He said, the way he phrases things is always, it's a really good lesson. He says, if you like some kind of unsolicited free advice, and I always appreciate it. And so he said, well, what if you kind of took a deal, one of the ones that we've worked on or one of the ones you've done on your own, and what if you went deep into it? And I thought, you know what, that's a great idea. So today, what I thought I would do is, actually, before I get into that, I will back up. I also took that opportunity to ask Andy if he would be interested in coming on my show. And he said that he was certainly interested. And so, although the format right now is just me talking, I've actually got two interviews this week with a gentleman that I'm going to bring onto the show. One who's a mortgage guy, and another gentleman out of the U.S. who I've followed and respect his work. So you're going to start to see a bit more of an interaction, and in fact, I did I don't know what you want to call it, like a Zoom call with a client, and he kind of asked me for almost an hour and a half questions on how I would invest money as a passive investor into a syndication. So what you're going to start to see is I'm going to test some different things, I guess is what I'm getting at. And I think that it's going to be a little bit more engaging. And I know whenever I have conversations with people, new things come out that I hadn't even thought of. So that's kind of number one. And number two, what you'll likely see is that I get pretty passionate and excited. Some people think I'm very intense, and I would say that that's probably accurate. And so I can't fight that or deny it. I just have to kind of embrace it. So I do my best to smile so that I'm not too intense, but it is what it is. So when I get into those interviews and conversations, likely a lot more animation, and you know what? Hopefully you still find value and enjoy it. So okay, now I want to get into this particular deal that I had mentioned, and if you're on the video, you can kind of see like these are like various deals that I've done in the past. I mean, there's I don't know like 8 or 10 of them here, and I thought which one could I pick, and I was going to do the Muskoka deal, although I could teach a whole course on that. Pretty much any deal you could really use it as like an entire course, in terms of how to invest in commercial real estate, and really a lot of the lessons on how not to invest, because I would say that a lot of the while pretty much all of our deals have been, I say pretty much because one of the deals, our first deal actually down in Palm Springs, that was what I would consider our worst deal, and that broke even. But it broke even because of the currency and the fact that we had purchased it all cash. We didn't have any debt on it. So that was just a timing factor, and probably, there's a few other kind of variables which we could go into at another time, but I really wanted to go into this mortgage portfolio. So this is a deal that was one of our first deals that Andy and I did, and it's quite interesting. So in 2008, I think it was around 2008, Andy, like I had basically left Sun Life as a commercial lender or underwriter. And prior to that, I had been investing as a residential investor, right? I was doing fix and flips. I was doing long-term rentals. At any one time I had anywhere from 5 to 8 houses on the go. So I was quite successful as a residential investor, but I was working my ass off and it really wasn't scalable. And the other challenge is you kind of tap out in terms of being able to get conventional debt. I had a couple of very successful new builds that did well, but when I got the opportunity to go into commercial real estate and really see how those type of deals manifested, it was very exciting. But I didn't have a playbook, right? I didn't have this documented approach in terms of how I find deals, how I finance them, how I fix them, how I raise money. Like I didn't have any of that when I started. It was basically, Andy had kind of 30 years of experience, and he said, or 40, I don't remember at that time, but minimum 30. And he said, look, let's start finding value add opportunities. And so I started to reach out to my connections that I had. Fortunately, because I was in the commercial world, I knew some people. So that was number one. And then number two is, I was just looking at my computer screen to make sure that the audio is working, which it is. Number two is I started to go on LinkedIn. And so I don't even remember when LinkedIn first started, but I was somewhat of an early adopter there, I think. And I would kind of search for kind of commercial real estate professionals, right? And literally we were looking across North America. So nothing was off the table, if you will. And I came across a gentleman in Boston. And in fact, I would say the first 3 or 4 big deals that I ever did came from LinkedIn. And we're talking like $20 million deals that resulted in multi-million-dollar paydays for my clients. But this particular deal was one that we did internally. And it was a gentleman out of Boston, if I recall. And he was representing a bank in Florida. And that bank had lent, I don't know the exact numbers, so I might be guessing a little bit, but I know for sure that they were lending billions of dollars into Canada, and they would typically lend on what were considered owner-user properties, which meant if you were a mechanic and you owned your own shop, your own warehouse, then you could go to this bank and you could borrow money directly from them. And it seemed to be quite a popular program, and they were what I would consider, once I started to get into the due diligence, they were very lenient on their lending criteria. And I'll get into that actually in a little bit. Okay, so I talked about the broker, Florida. Okay, so some of the criteria, and I might use some jargon and whatnot. I'll try to explain it as best I can. But they would typically lend 20 to 30 year fully amortized loans, meaning if you went in to borrow money from them, you could essentially secure your mortgage or your debt for the entire term of 20 to 30 years. I think a lot of them were 25 year. So that meant you had your interest rate of, let's say, 5%. Well, actually, all these interest rates were much higher. They were kind of in that 8 to 10%, if I recall. Actually, 8 to 12%. So these borrowers were not able to get conventional financing. Conventional meaning you couldn't go to a bank or a credit union or a tier 1 bank. So they were going to this kind of tier 2 bank, and they were getting good leverage, about 65 to 75% loan to purchase price, or loan to value actually, because most of these people or businesses already own their buildings. And they would go in, and if you've ever done a commercial loan, you know how much paperwork is involved. With this lender out of the U.S., they had really tried to streamline it, and they were allowing a lot of the third-party reports, like an environmental report or a building condition report. They did need appraisals, but most of the reports that they did, they just insured against. And I don't want to get into the complexity or the reasons why, but essentially what they would do, instead of getting an environmental report where maybe you would have to go out and drill holes on your site to verify whether or not there was any contamination, they would basically purchase insurance against that, and likely there was probably some very old environmental report on the property, but it was certainly eye-opening. And when I started to see how this bank was essentially just, they had a ton of money and they were just trying to push it into the market. That's probably the best way I could describe it. And in fact, when I had a conversation, I'm jumping ahead a little bit, but I had a conversation with like the main guy at this bank. And I asked him, because Andy and I, we started to tour a portfolio that they were trying to sell. So they had a portfolio of, I want to say, 58 mortgages spread across Canada. And so, I mean, like we're talking from Halifax to Victoria or Vancouver Island. And if you know Canada, that's a tremendous amount of land that you're going to have to cover to look at all these different properties. So I organized the 58 properties by size, and I started to look at the closest properties. So anything that was near me in Calgary or in Alberta, I drove to. And I wasn't impressed, frankly. However, there were some properties that I quite liked. And so what we started to do was, Andy and I basically, we got on a plane and we flew out to BC and we toured all the properties in BC. I'd already driven, and Andy and I drove some of the properties here in Alberta. And the ones that were in Saskatchewan and Manitoba, there weren't very many. So it didn't justify our time at that point to go look at those yet. So we flew out to Halifax and we spent 4 days and probably logged about, I don't know, 2,000 miles at least, right? Because we were driving to each one of these properties. And I've got them here. So I'll just kind of talk about where some of these properties were located. So in Halifax, there was one just outside in Upper Tantalon, Upper Tantalon, I'm just trying to remember because it's been a little while. Yeah, Upper Tantalon, that's just outside Halifax, very close to like Peggy's Cove, Kentville, Sussex, St. John, Ottawa, Callender Bay. And long story short, actually we've got kind of a cool map. So if you're watching the video, you can see where we drove and where we flew. And it was a really neat experience to be able to kind of go look at all these properties. But it was our belief that, number one, we had to see every single property. And number two, even though we were technically not allowed to interview the owners of these properties, interview them in the sense that we couldn't go in saying we were prospective buyers of the mortgages. But we were allowed to kind of quietly have discussions with the owners of these properties. And so that's what we did. We went to every property. We interviewed them in the sense that if we were a client going into, one was a funeral shop, for example, so that was quite interesting. We couldn't explain exactly what we were doing, but we had a very nice conversation with the owner. And you get a sense, because if you've never met any of your prospective clients, right? Because these clients, whether we had the mortgages or we had to look at every one of these deals like we were going to own the property, because if the business owner goes out of business, then we're going to have to take over that property and we're going to have to operate it. And so we wanted to know a few different things. Number one, who is the business owner? Number two, how successful are they? Are they going to be able to continue to pay us? And number three, if they go out of business, what can we do with that property? And I will tell you that a lot of the lessons that I learned from this particular deal, because of the 58 mortgages, we purchased 7. And of those 7, 3 went into foreclosure, meaning we had to either take them back or go through a foreclosure process. And we were accommodating because, quite frankly, there wasn't a lot of buyers in these small markets, so we really had to work with them. But I'll kind of back up, because I think I kind of opened this loop earlier when I was talking to the VP or the director of this bank. That was, I mean, they were huge. They were multi-billion-dollar bank, and I had asked him. I said, "Have you looked at any of these properties?" And if I've already said this, then I apologize, because sometimes I can't remember if I told this story already or if it was another client that I was telling. And he said, "You know what, Shane?" He's like, "We were lending 250 million a month." He's like, "There is no way I would have had time to look at every one of these properties." And at that point, I knew, and this was during a pretty intense negotiation, because initially the bank was just like, "Look, take it or leave it. Like, we're not here to mess around and, cherry pick all the properties that you guys want to lend on and the ones that you don't want to lend on." So what we did is we isolated all, and it was quite interesting, because everything that was west of Ontario were loans that we really were not all that interested in. And actually, during our due diligence, which, let's say, we had, I want to say, between 45 and 60 days, 3 of those deals went into foreclosure during that time. And so we knew that we really had to understand the underlying real estate, the fundamentals of that real estate, before we could make a educated offer. And so in this particular case, I want to say that of the 7 mortgages, we were able to purchase those mortgages at 60% of the face value. And so I'll describe that here real quick. Let's just say that the portfolio was $10 million, and we were able to purchase those mortgages for $6 million. The face rate, meaning the actual interest rate, let's say was on average 10%. Well, 10% on 10 million would be, this is always horrible when you're trying to do math on, but 10% of 10 million would be $1 million a year in principal, in it, or that would be the interest that would be collected, right? If it was just simple interest. Now, these were all fully amortizing, so it was obviously higher than that, but let's just say that it was simple interest. Now, if I'm buying these mortgages at 60 cents on the dollar, you start to see the leverage that we were getting. And so as long as the mortgages were performing, we were collecting, these aren't the exact numbers, but I just want to use it for illustration, but we were collecting $1 million a year on a $6 million investment. And so essentially in 6 years, we would have received all our money back out of the deal. And actually, those numbers are pretty, they line up pretty good. It was actually a little bit higher than that. I think our average return on investment, this may not be exact, but it was over 21% over 6.5 years. And so the deal worked out tremendous, but there was a lot of very interesting lessons that I learned on this deal. And a few of those that I thought I would share are, number one, the fact that we had to tour all of Canada in order to identify these properties took a tremendous amount of time and energy. And that's okay if the deal is big enough to justify it, right? If this was a $30 million deal and we could have pushed it to 60 million, then the amount of time and energy that goes into finding these and looking at every one of these properties was worth it. Now, I'm not saying it wasn't worth it because of the experience, so I would never take away from that. But would I do that deal again? I would probably do that deal, but I wouldn't have as many partners because, frankly, there just wasn't enough juice in the deal. I want to say that this deal was about 3 million, and at the end of the day, let's say it would have netted out around 6. Now that might sound like a lot of money, right? $3 million. But if you've got 15 or 20 investors, and you start to split that pie up a lot, there's not as much profit at the end of the day. So while it was good, that is probably the first lesson: is the deal big enough? Number two, had those properties all been kind of within an hour of me, that would have saved a tremendous amount of time, especially once these deals started to go into foreclosure. Trying to manage a property in St. John or in Ontario that's in foreclosure, now I'm having to deal with lawyers. Like, we had different lawyers in every province. We had different consultants and contractors that we needed. And so logistically, it required a tremendous amount of energy and time. Now, because I did this full time, I was able to manage it. But if you were to break down my hourly rate, it's a little bit laughable. However, like I said, all this experience has really taught me some tremendous lessons on how to invest in commercial real estate. So those were, okay, I just want to make sure that okay, so we talked about all that. We talked about that. So we talked about the scale. We talked about the fact that it would be great if the deals were in my backyard. Number three, and so that really goes into why you need to be able to look at every single deal. Like, we could not accept or rely on third-party reports. So this is kind of another very important principle. Just because there's an appraisal that says it's worth $1 million, I will tell you, especially when you get into small towns, those appraisals are typically very generous, and I don't put a lot of weight on them because, and I don't want to get into it because I don't want to get a bunch of emails from appraisers, but the truth is the appraiser is not the one that's going to have to take it back or own it at the end of the day. And so while it's nice to have and what banks require, I need to verify that. And I verify it by talking to people that are experts in the industry that are either leasing or selling. And I say, how much can you get for that if I need to fire sale that tomorrow? And that gives me an idea of what that thing is really worth. Another lesson, if you will, is that commercial real estate is work. And what I mean by that is, like, we had to interview all of these business owners and look at the properties and then talk to consultants and do surveys and all, like, it was just there is a tremendous amount of work. And I don't want to downplay that because I think what happens is a lot of people that come into commercial real estate or into the investing world of real estate, they think that it's make money fast, easy, and wholesaling lease options, and maybe it is. I don't know. I've never found real estate investing to be easy. Anytime it was easy, it's also easy to lose money. And so what I'm trying to do is kind of give you like the real, like how commercial real estate investors do this. And I think if you talk to any of them, they would say, no, it's not easy. But I don't know too many places that you can make 7 and 8 figures on a deal. That's easy. I guess the lotto is probably one, but that's winning. That's not working. That's not earning it, if you will. So we looked at every deal. We knew that it was going to require a tremendous amount of time. The scale had to be big enough. What is the other thing I wanted to mention? Verifying everything on the third-party reports. And the last thing is why I really don't like small towns. I grew up in a small town, so I get it. The reason I'm not keen on investing in small towns is typically there's one buyer or no buyers. And I don't like that as an owner of real estate. So while I see a lot of, not a lot, I see some gurus out there as it relates to, say, apartments or commercial real estate going into small towns and talking about these kind of high returns they're getting. Well, in my opinion, the returns are, in most cases, they're not high enough to justify the risk that I am taking. And so if you live in a small town and you truly understand it, that is one thing. But to go into a small town just because there's an opportunity, because you might be able to get a 8 cap or a 10 cap on a deal, I would look at it and say, why is it that they are offering that high of a cap rate? And it's likely because there's very little liquidity, meaning you can't sell it. There's very few buyers for it. And what's the upside? I mean, a lot of investors going into a small town typically want those high returns. And so I've got a friend who's likely going to hire me as a client to help him on a project. And I told him, I said, look, I know you like this property because it's got a high yield and a high cap rate today, and you might be able to fill that vacancy, but who's your buyer on the back end? And what I mean by that is, like, who's going to take you out of that deal because you've added all the value, and the most likely buyer is someone that wants to do what you're doing. And so if you can't find that buyer, now all of a sudden you're going to get jammed up with that property. And so that's how I look at it. Now, he will look at it very differently. I'm just trying to give you how I think about these investments. And like I said, if you know how to analyze and think about commercial real estate, when you get into situations that are different and tricky, because let's face it, even if I gave you the 3 different binders that I have that I use as my framework for investing in commercial real estate, something's going to come up. Every deal is different. So my main goal of the podcast and these videos is to teach you how I think. And then that way, when you get into a situation, you're going to be able to say, oh, okay, I see that. And, if I filter it through the scorecard that Shane's created, or his book, or, some of these other resources, then you're able to protect yourself. And that's really my main focus, is to make sure that you don't make like $1 million mistake in commercial real estate, because that's I've seen it, and I've seen guys that will lose everything, yeah, it can be very devastating. So, anyways, I don't want to get into all that. What I did want to talk about is, if you haven't already downloaded, go to clubsyndication.com /scorecard, and that will give you how I filter deals. You can also get my book. I think you just type in clubsyndication.com and you can go and download a copy of my book for free, where I go into how I think about investing in commercial real estate a little bit more. Last, I do want to thank, I just checked out the other day on my podcast, and I noticed that I had 2 new reviews, 5 stars. And I want to say I appreciate that. Thank you very much. I wish I had their names handy. Maybe I'll do that on the next podcast. And if you enjoy the show and the information and content, leave me a 5-star, and write a review on what you took away from this particular episode, if you will. I think that that's very helpful for other people that are looking for podcasts, and they'll be able to kind of identify whether or not it makes sense, because this isn't for everybody. I'm not trying to pander to everybody that wants to, quote unquote, make money in real estate. This is really how to grow and keep your money. And of course, you can make good money in commercial real estate, but most of the people have money and they're bringing it into commercial real estate. So that's it for today. Hope you enjoyed this. If you like this, where I go deep into a deal, if you want me to talk about any of the other deals, let me know. Because I'm always trying to improve and make these podcasts better. So that's it for today. We'll see you tomorrow. Not tomorrow, next week.